2 weeks ago, I sold another $3 billion in Bank of America stock, reducing my stake to levels I haven't seen since 2019. Wall Street called it portfolio rebalancing. But let me tell you what's really happening. I'm seeing the same warning signs in the banking system that I saw in 2007, right before everything collapsed. Regional banks are sitting on unrealized losses of more than $500 billion in government security. Default rates on commercial loans are rising for the first time since the pandemic. And regulators are doing exactly what they did in 2008, pretending everything is fine while fire burns in the basement. Let me be absolutely clear about what I'm seeing here. The American banking system is structurally weaker today than it was before the 2008 crisis. You don't hear this on CNBC. You don't read it in the optimistic reports from Wall Street analysts. But when you actually examine the balance sheets, when you look at what banks are holding and how they're financing their operation, the picture is terrifying. And 2026 could be the year when all this hidden fragility explodes publicly. Over the last 12 months, 3 major regional banks failed: Silicon Valley Bank, Signature Bank, and First Republic. Together, they represented over $500 billion in assets that disappeared practically overnight. The Federal Reserve and FDIC intervened with emergency programs to prevent a mass bank run. It worked temporarily. People forgot. The stock market recovered. But the fundamental problem that caused those failures wasn't solved. It was just swept under the rug with trillions in government guarantees. Here's what keeps me up at night. Those 3 banks that failed weren't poorly managed institutions making risky loans to people who couldn't afford them. They failed because they had U.S. Treasury securities that lost value when interest rates rose. Think about the insanity of that for a moment. Banks failed holding supposedly the safest assets in the world. If government securities can destroy banks, what else is hiding in balance sheets that nobody's talking about? Charlie Munger told me years ago that the modern banking system is fundamentally fragile because it operates with an absurd amount of leverage and depends entirely on public confidence. The moment that confidence wavers, even for irrational reasons, the entire system can collapse in days. We saw this in March 2023 with SVB. Deposits of $42 billion left in less than 24 hours. The best capitalized bank in the world can't survive that kind of run. And now, as we enter 2026, I see conditions forming for a much larger run involving many more banks, with consequences that will make 2008 look manageable. Now let me explain exactly what's happening in bank balance sheets, because this is critical to understanding why we're heading toward another crisis. When the Federal Reserve raised interest rates from practically 0 to 5.5% in just 18 months, something fundamental broke in the banking system. Every bank in the United States owns government securities and mortgage-backed securities they bought when rates were low. Those securities are now worth much less than what banks paid for them. And we're talking about massive losses. Here are the numbers that should frighten anyone with money in a bank. American banks are currently sitting on approximately $515 billion in unrealized losses on held-to-maturity securities. Let me translate that into plain language. Banks are holding investments that, if forced to sell today, would generate over $500 billion in losses. But because these securities are classified as held to maturity, banks don't need to mark those losses on their balance sheet. It's perfectly legal accounting, but it's completely misleading about the true financial health of these institutions. Think about what this means in practice. If you have $100,000 deposited in a regional bank, that bank might be showing a healthy balance sheet while being technically insolvent if it had to liquidate its assets at market value. The only reason the bank still functions is because everyone assumes they can hold those securities until maturity and eventually get the full value back. But what happens if there's a bank run and they need cash immediately? They have to sell those securities at huge losses, and suddenly a bank that seems solid is on the brink of failure. This is exactly what killed Silicon Valley Bank in March 2023. They had $21 billion in unrealized losses on a securities portfolio of $117 billion. When their tech clients started withdrawing deposits en masse due to the difficult startup environment, SVB was forced to sell securities to raise cash. Those sales realized the losses, destroying their capital. In less than 48 hours, a bank with $209 billion in assets was bankrupt. And here's the terrifying part. Hundreds of other banks have exactly the same structural exposure. Let me give you a simple analogy of what's happening. Imagine you bought a house for $500,000 when mortgage rates were at 3%. Now rates are at 7%, and similar houses are selling for $350,000. On paper, you still own a $500,000 house because you're not selling. But if you suddenly need to sell, you realize a $150,000 loss. Banks are in this exact situation with trillions of dollars in securities. And the longer the Federal Reserve keeps rates high, the deeper these unrealized losses become. We're sitting on an accounting time bomb that just needs a trigger to explode. But unrealized losses on securities are only half the problem. The other half, and possibly even more dangerous, is happening in banks' commercial loan portfolios. And when I look at the data on commercial real estate specifically, I see the kind of deterioration that precedes financial disasters. Regional banks have trillions loaned against office buildings, shopping malls, and commercial properties that are now worth much less than when the loans were made. And default rates are starting to rise alarmingly. Here are the numbers that make me lose sleep. American banks have approximately $2.9 trillion in commercial real estate loans on their books. Of that total, about $900 billion are loans for office buildings. But since the pandemic, remote work has destroyed demand for office space. Vacancy rates in major cities are above 20%, the highest levels in decades. And when these loans mature, owners can't refinance because the buildings are no longer worth enough to secure new loans at current interest rate levels. Let me give you a concrete example. An office building in San Francisco that was valued at $300 million in 2019 might be worth only $150 million today. The bank made a $210 million loan against that building, assuming they could always recover their money, because the property was worth much more than the loan. But now, with the building worth only $150 million and the loan maturing, what happens? The owner can't refinance. They don't have enough equity. So they hand the keys to the bank in a foreclosure. And suddenly the bank owns a building worth $60 million less than the loan they made. Multiply that scenario by thousands of buildings across the country, and you begin to understand the magnitude of the problem. Regional banks, which concentrated their loans in their local geographic areas, are particularly exposed. They don't have the diversification of large national banks. A regional bank in a city where commercial real estate is imploding could see 30% or 40% of their commercial loan portfolio getting into trouble simultaneously. And when that happens, there isn't enough capital to absorb the losses. What makes this even worse is the timing. Many of these commercial loans were made between 2020 and 2022 with 3 to 5 year terms. That means a huge wave of maturities is arriving in 2025 and 2026. Owners who took loans at 3% or 4% now need to refinance at 7% or 8%, while their properties have dropped in value. That combination is toxic. And when you add the fact that many of these loans were made based on inflated valuations during the hot post-pandemic market, you have a perfect storm of mass defaults forming right now. Let me explain why specifically 2026 concerns me so much, because it's no coincidence I'm raising my alert exactly now. There's a convergence of factors happening simultaneously that creates the kind of environment where banking crises don't just can happen, but probably will happen. First, we have the wall of commercial loan maturities I mentioned. Approximately $1.5 trillion in commercial real estate loans mature between 2025 and 2027, with the largest concentration in 2026. This isn't speculation. This is concrete data from loan schedules. Second, and equally important, the Federal Reserve is in an impossible position. They want to cut interest rates to relieve pressure on banks and commercial property owners, but they can't cut much because inflation still isn't fully controlled. So we're seeing timid quarter-point cuts here and there when what the banking system really needs is rates going back to 2% or 3%. But if the Fed did that, we'd risk inflation spiking again. They're trapped between destroying banks with high rates or destroying the currency with rates too low. Here's the third factor that makes 2026 particularly dangerous. The emergency programs the Federal Reserve implemented in March 2023 to stabilize the banking system after the SVB and other failures are ending. The Bank Term Funding Program, which allowed banks to borrow against their securities at face value instead of market value, expired in March 2024. This means banks no longer have that safety net. If there's another run, they'll have to sell securities at losses or find another source of liquidity quickly. Think also about the broader economic context. American consumers have record levels of credit card debt. Savings rates are at historic lows. Auto loan delinquencies are rising. Consumer confidence is weak. When you put all this together, you have an economy that's much more fragile than the relatively low unemployment numbers suggest. And fragile economies don't handle financial shocks well. I've seen this pattern before in 2007. Everyone looked at the rising stock market and low unemployment rate and assumed everything was fine. But underneath the surface, massive problems were building in the subprime mortgage market. Regulators knew, but did nothing because they didn't want to spook the markets. And then, when the problem finally exploded in 2008, it was much worse than it would have been if they'd dealt with it earlier. We're in exactly the same situation now, with regional banks sitting on massive losses and bad commercial loans, while regulators reassure everyone the system is solid. You know what really frustrates me about the current situation? We should have learned from 2008. After that crisis, regulators implemented Dodd-Frank stress tests and dozens of other reforms supposedly to ensure we'd never again have to bail out banks with taxpayer money. But here we are, less than 2 decades later, looking at problems that are structurally identical to those that caused the last crisis. The names have changed, the specific products are different, but the fundamental dynamics are exactly the same. Excessive leverage, concentrated risk, and regulators looking the other way. Let me tell you about one of the biggest lies Wall Street and Washington told you after 2008. They said the big banks were now too big to fail. So they made the rules stricter for large institutions. But you know what they did for smaller regional banks? They loosened the rules. In 2018, Congress passed legislation that reduced regulatory requirements for banks with less than $250 billion in assets. The argument was that these smaller banks didn't pose systemic risk and were being burdened with unnecessary bureaucracy. Now fast forward to March 2023. Silicon Valley Bank had $209 billion in assets. Signature Bank had $110 billion. First Republic had $213 billion. All of them were below the $250 billion threshold and therefore faced lighter oversight. And all of them failed within days, requiring massive government interventions to prevent contagion. The argument that regional banks don't pose systemic risk was completely destroyed by reality. But regulators still haven't reversed those 2018 changes. They're still operating under the fiction that only the biggest banks matter. Here's another lesson nobody learned. In 2008, the problem was mortgage-backed securities that banks didn't fully understand and rating agencies had incorrectly rated. Everyone said we'll never again blindly trust AAA rating. We'll never again assume complex assets are safe just because mathematical models say they are. But you know what banks did this time? They assumed U.S. Treasury securities were perfectly safe regardless of how much they paid for them or where interest rates were heading. They didn't do adequate stress testing for rising interest rate scenarios. The SVB is the perfect example of this failure. They had a risk management department that should have been modeling what would happen if interest rates rose rapidly. But apparently nobody actually believed the Fed would raise rates as aggressively as they did. So they didn't hedge adequately. They didn't diversify their portfolio. And when rates went from 0 to 5% in less than 2 years, they were caught completely unprepared. This isn't bad luck. This is managerial incompetence combined with regulatory failure. And it's happening at hundreds of other banks that haven't failed, yet only because they haven't faced a run yet. So here we are. The banking system is sitting on over $500 billion in unrealized losses on securities. Trillions in commercial loans are heading toward default as they mature in 2026 and can't be refinanced at current rates. Regulators are repeating the same mistakes from 2008, pretending regional banks don't pose systemic risk. And the Federal Reserve is trapped between keeping rates high and destroying banks or cutting rates and risking inflation. To me, this isn't a question of whether another banking crisis will happen. It's a question of when and how severe it will be. Let me be absolutely clear about what I'm doing with my own money, because actions speak louder than words. I've reduced my stake in Bank of America by more than 40% in recent months. Not because BofA is a poorly managed bank. They're actually one of the best. But even the best banks will suffer when the entire system faces pressure. And when you see the warning signs I'm seeing, you don't wait for confirmation. You act while you can still exit at reasonable prices. That's exactly what I did before 2008, and it's exactly what I'm doing now. For individual investors, my advice is straightforward. First, understand where your money is. If you have more than $250,000 in any single bank, you're exposed because FDIC insurance only covers up to that amount. Split your deposits across multiple institutions if necessary. Second, look at your bank's health. Small regional banks with heavy exposure to commercial real estate in their geographic areas are most vulnerable. You can find any bank's financial reports on the FDIC website. If you see lots of commercial loans in a large securities portfolio, consider moving your money. Third, and this is crucial, don't assume that because a bank has survived until now, it will survive what comes next. SVB was operating normally on a Tuesday and bankrupt on Thursday. First Republic was trading at $115 a share in January 2023 and went into receivership in May. Modern bank runs happen at internet speed. You might have days or even hours to react once problems become public. So don't wait for obvious signs of trouble. If you're nervous about your bank, move the money now while it's easy. As for investments in bank stocks, I would be extremely cautious. Regional bank stocks might look cheap based on traditional price to book metrics, but that book value doesn't reflect the unrealized losses they're carrying. When those losses eventually have to be recognized, either through forced securities sales or commercial loan defaults, book value will evaporate quickly. You might think you're buying bank stocks at 80% of book value when you're actually paying 120% of real market adjusted book value. That's not a bargain. That's a value trap. The biggest lesson I've learned in over 70 years of investing is simple. When you see serious risk forming, you don't need absolute certainty to act. You don't need to know exactly when or how the crisis will unfold. You just need to recognize that the odds have shifted against you. The banking system today is structurally weaker, more leveraged, and more vulnerable to shocks than most people realize. Regulators won't warn you until it's too late, just like they didn't warn in 2008. Wall Street will keep saying everything's fine until the day it isn't. So it's up to you to protect your own capital. 2026 could be the year this hidden fragility explodes into public crisis. And when that happens, people who acted early will be glad they were cautious. People who waited for confirmation will wish they'd paid attention to the warnings. I've given my warning. What you do with it is up to you.